Welcome back, everyone. This is the oil market review for the 17th of March. WTI could be heading for its second week in red territory. Even though the commodity surged to a new multi-year high on the 8th of March, its correction to lower grounds in the following daily sessions was substantial and the ground lost was very evident. In this report, we will be taking a closer look into the current, most important fundamental updates in the oil market and how these can affect prices in the short term. Along with these fundamentals, we also present a technical analysis pointing out trade-related information for WTI. Enjoy the report. In the past week, the U.S. Baker Hughes oil rig count indicated active oil rigs in the United States increased from previous 519 to 527. No major reaction was observed on oil prices upon release, yet the ongoing increase in active oil rigs continues to signal red-hot demand for fuel. On the 15th of March, the American Petroleum Institute inventory levels reading pointed to a surplus of plus 3.75 million barrels. Even though instant market reaction was not observed, WTI carried out a full daily session moving downwards. On the next day, the Energy Information Administration's crude oil inventories displayed an even larger surplus of plus 4.35 million barrels, and WTI lost approximately $1 in the following minutes. Despite the EIA and the API readings favoring a bearish sentiment, the downward trend for the commodity had formed before the release of these figures, which could imply that other fundamentals are currently driving the overall direction of oil prices. It should be made clear that the Biden administration is under pressure within the United States as oil prices touched decade highs. This may force the Biden administration to take desperate actions in order to find a solution that could bring oil prices lower. Traders are advised to be cautious of headlines on this front. At the moment, the oil market continues to focus on Russia's contribution to the global oil market supply. Even though countries like the United States have already taken action to cut dependence on Russian oil, it is still uncertain who will step in and cover for the lost production. Some analysts are currently reducing oil demand expectations in the near future as oil prices were extremely high in the past weeks, making purchases somewhat unaffordable and uneconomical. Moreover, contradicting information on the Ukraine war seems to have led to mixed signals in the past days, with some media sources pointing to improved talks between the two sides, while on the other hand, Russian military attacks may have worsened in the current week. However, the ongoing developments of the matter in the past weeks may have forced the oil market volatility to extraordinary levels. On a separate note, headlines on the new wave of virus cases in China seems to be an important matter to consider for oil traders at this point. The new wave is considerable for the reason that it is the largest since the 2020 Wuhan outbreak. The new wave has the potential of disturbing oil demand and consumption in China, which is the largest oil-consuming nation globally. With the new lockdowns and traveling measures imposed, we could expect some oil demand to be reduced, ultimately sending bearish tendencies for oil prices. Even though the effect on oil prices may have already been priced in by the market, this subject may require constant monitoring by oil traders as more volatility could be unleashed as headlines make their way out. All eyes turn now towards the OPEC Plus group, which seems like the most determining factor for oil supply at this point. The OPEC Plus group may be keeping its agreement to increase supply by modest monthly amounts, yet the global market could be severely destabilized and damaged if action is not taken soon. According to the IEA, Saudi Arabia and the United Arab Emirates are among the group players that continue to hold spare capacity and can be used to offset a Russian shortfall. Furthermore, in the past months, OPEC members had failed to produce the actual levels they had initially agreed to. In this case, they may have to uplift production. We move now to our WTI technical analysis. Please note this is WTI's 4-hour chart. WTI seems to have a strong support at the S1 93.75 line, which was tested constantly from the 15th to the 17th of March, but failed to be breached. In the most recent sessions, oil seems to have regained some ground to the upside, with the price action possibly heading to the R1 101.15 resistance. If this trend is extended even further, the R2 104.05 and the R3 106.95 could be the next steps higher for oil traders to keep in mind. However, if oil prices are to perform a movement to the downside, a move below the S1 can signal the price action is falling into territory that was previously seen in February. In our opinion, the S2 19.60 level and the S3 87.55 can be used in case the selling increases. Overall, we tend to maintain a bias for a sideways motion for WTI, since the rebound in the most recent sessions has sent the RSI indicator from 35 to the 50 level. Yet, for us to change our outlook to a more bullish one, WTI would have to engage the R4 110.20 level. A final comment that could cover for the commodities' recent price action is that despite the correction so far in the past week, crude oil remains in positive territory for March, which may be evidence of an extreme bullish interest in the first week of the month. Thank you very much for your time and focus. We appreciate your participation. And if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.